Hi, I'm Dean Orrico, and I'm joined today by my colleague, Rob Lauzon, and together we manage the Middlefield Canadian Income Trust Fund. And this presentation today is really an update on how the fund's positioned and why we think it represents an excellent opportunity, especially for UK investors to get exposure to a market, specifically in Canada, that we think really represents exceptional value. This fund was launched in 2006, and it's been equity income focused really since it was launched. It is primarily a Canadian fund. It has the ability to invest in the US, but today, just given the relative value that we're seeing in the Canadian market, we're really excited about the opportunity for this fund to continue to generate high levels of income, plus very attractive total returns for investors. So as we describe here on this slide, we really believe this is a generational opportunity to buy Canadian dividend stocks. And specifically, what's been the headwind for Canadian dividend stocks and dividend stocks generally over the past 12 to 18 months has been this continual rise in interest rates. And we've had the short end of the curve move up by about 500 basis points. And then more recently, we've seen the long end of the curve basically touch about 5% in the US, about 100 basis points less in Canada, but it's also been rising. And that peaked in the last 2 weeks. And we really think that's representing an inflection point here where rates have basically peaked and are going to at least flatline and then eventually in 2024 continue to gradually move lower. So with that now becoming more of a tailwind than what's been a headwind in the last 18 months, we think that really is going to represent renewed focus for Canadian dividend stocks. And that's also as a result of this real drop in inflation. We've seen inflation in Canada peak at about 6 to 7%, now down to 3.5 to 4%, a little bit higher in the UK or the US. But generally speaking, inflation levels have come back down. And players like the Bank of Canada or the Federal Reserve in the US are making it clear that at most there's another quarter point bump ahead of us, but basically that's it. So that's giving us this added confidence that we think the short end of the curve is basically done going higher, really presenting a more attractive backdrop for dividend paying stocks. And then last but not least, we think there really represents attractive value in the Canadian stock market generally. And that's what you're seeing on this slide is that really we're trading at a substantial discount when you look at this historically to our counterparts in the US. Even when you take out the technology sector, which represents some 27-30% of the US market, you take that out, Canada's still trading at about a 2-turn discount to its US counterparts. Again, our focus here is on dividend growth. And as you can see, our portfolio has grown by about its dividends have grown by about 9% per annum over the last 5 years, well above any other benchmark. And in fact, as we highlight on this slide, almost 90% of our portfolio companies have actually grown their dividend over the last 5 years, and about 50% have actually grown it every year over the past 5 years. So again, our focus is on dividend growth companies. We haven't had any cuts in dividends over the last several years. So again, we think that really does represent an attractive opportunity for investors to get growing levels of income into their portfolio. This slide basically shows how the portfolio is positioned today. And as you can see, we continue to be very constructive on the energy market. Almost 40% of this fund is split between energy producers and pipelines. And my colleague Rob will talk about this in a bit more detail. We also have a significant overweight position in REITs. These are publicly listed REITs, all of whom trade on the Toronto Stock Exchange, but they have assets that are in Canada, the US, and even in Europe. But generally speaking, we think this represents tremendous value. And in fact, since the long end of the curve peaked about 2 weeks ago, you've seen a tremendous recovery in publicly traded REITs here in Canada. And we think there's continued momentum ahead of them. Financials represent about 20%. Rob will talk about financials a little bit and how we're below the benchmark. We continue to be very constructive and highly positive on our Canadian banks. We just think that there are some headwinds in the near term, and that's why we're underweight. And then last but certainly not least, we've got roughly a market weight in the utilities area. This has been a laggard in the portfolio on a year-to-date basis, but again, with our view on rates peaking and at least moving sideways and eventually moving lower later next year, we think the utilities are well positioned for attractive total returns. This slide basically shows our performance over time, and again, very competitive and ahead of our benchmark since inception. And on portfolio itself, I will talk about the real estate sector and why we continue to think this is an attractive area to be invested. And I'll turn it over to Rob to focus a little bit more on energy, pipelines, as well as financials. But first and foremost, on the real estate sector, again, we're seeing some of these businesses with fundamentals that, quite frankly, haven't been this good in over a decade. So we're seeing very strong fundamentals, and we're seeing very significant discounts to net asset value. As you can see on this slide, our REITs on average are trading at 25 to 30% discounts to their NAV. That's certainly skewed lower by office REITs, which are trading at 40 and 50% discounts to NAV. And to be clear, we don't have any exposure to office in this portfolio. Our focus is primarily on industrials, open air retail, that is grocery anchored or necessity-based retail. And then we've also got a strong position in the multifamily or apartment REITs. And generally speaking, we think the fundamentals in those areas, as well as in some senior care REITs in Canada, we think they're extremely positive right now. And with this, rate environment that's going to be more conducive to owning REITs, we think they're really well positioned going into next year with very positive supply-demand fundamentals, as well as some very strong balance sheets and very strong liquidity ratios. Our best quality REITs in Canada, whether it be in the industrial sector or in the open air retail sector, have done a very good job managing their portfolios, running down their payout ratios, and in essence, really being well positioned for a much more conducive macroeconomic environment to deliver not only strong yields that are well covered, but also a real capital appreciation potential by virtue of their re-rating as we go into 2024. I highlight a couple of them on this slide, specifically Dream Industrial REIT and Choice Properties, two of our core holdings. If you're interested in learning a little bit more about each one of these core holdings, I've recently done a fireside chat with the CEOs of both of these entities, which is on our website, and I encourage you to go and listen to those interviews, and you can hear firsthand why these management teams are as excited about the business as we sit here today going into 2024. So with that, I'm going to turn it over to Rob, who will talk a little bit more about the energy part of the portfolio, as well as touch on our views on the Canadian banks and financials generally. Rob?
Yeah, thanks, Dean. Really excited about how we're positioned in the energy sector right now in the fund, and what the future has for Canadian energy pipelines and oil and gas producers. Momentum is building, and it's not only building in the fundamentals of the companies we're investing in, but I think how foreign investors are viewing Canadian energy stocks, which should be a positive catalyst for fund flows. But as you can see with this chart in front of me, there's three lines here, and it's really expressing how well the fundamentals are currently for our energy producers. We've gone through some tough times, the toughest being during COVID, when oil went negative and traded at $0 for a few days there, and that was really a catalyst to spur our companies to be no longer reliant on banks, outside capital, both on the debt and equity markets, and to look internally and live within their means. So they've been heads down trying to reduce debt to more adequate levels, and many of our companies are going to be debt free at the end of this year and definitely hit their debt targets by by 2024 if they're willing to carry a little bit of debt. But they're running with very low levels of debt. And that's fabulous in these higher rate environments than we've experienced over the last decade. And they don't want to be at the whim of the equity markets either. So M&A is not a core strategy for any of our companies. They're not growing for the sake of growing and just to grow their nominal production numbers. So by that, they're really looking to return a lot of shareholder capital in the forms of both dividends and share buybacks because they're so profitable. The Saudis really still run the oil market and can take barrels on and off the market when OPEC plus meets throughout the year. And, given the fundamental needs of what the Saudis and other Middle East nations need for their own internal funding needs of their governments, we're quite convinced that the Saudis will do whatever they can to keep Brent oil prices above $70. And in that operating environment where we stand today, it's very profitable for our Canadian oil producers. And then on the natural gas side, we've got a big pull of new demand coming to North America with more LNG projects hitting our shores, and we have a new buyer. So both European and Asian buyers are coming to North America to buy our LNG. And in fact, Canada will have its first shipment of LNG off the west coast of Canada in 2025. So that's going to support our pricing as well. So basically, return on equities, this red line on this graph is showing you how profitable our companies are right now. The gray line shows our debt levels, and valuation is what we do every day. Look at valuations of our portfolios as portfolio managers, and they're still at trough multiples. So we're quite excited about how these energy producers look. And as a ballast to our energy portfolio are the pipelines that really is an investment in an energy infrastructure, moving these molecules of both natural gas and oil around North America. And the outlook is quite bright there. The slide here really just is a poster child stock for MCT, and that is Canadian Natural Resources. These are the attributes we look at for all dividend stocks in our portfolio, companies that can consistently pay dividends and grow dividends. And CNQ has grown its dividend for 23 consecutive years, and that's during the Great Financial Crisis, that's during COVID, and more recently have really turned up the dial on its dividend growth rate of over 20% per year over the last 5 years. In fact, last week in their earnings call, off cycle, because typically they raise their dividend annually in March, off cycle here in November, they bumped their dividend by 11%. So we're still expecting another dividend bump come next March as per normal. So we're quite excited with the amount of free cash flow CNQ has and will be returning to us both in the form of growing dividends and share buybacks. And notwithstanding the fundamentals of the company, they're part of an organization called the Oil Sands Pathways, and their goal is to become essentially emissions free and create the lowest carbon barrel of oil and selling to the market, which should actually trade at a premium at some point over the next couple decades as they capture most of the carbon from our oil sands operation and sequester it into the geological formations in Western Canada. I think it's a good time maybe to pivot to financials, which will always be a fairly core portion of this portfolio. And in fact, our benchmark is around 30% financials, Canadian financials. We're running close to 20% right now, which is a still healthy weighting, but underweight versus the benchmark. And we just don't see any near-term catalysts this quarter or next quarter in the Canadian financials. So we may become more constructive latter half of 2024, but in the next couple quarters, we're okay being underweight. We see better opportunities in REITs, for example, and a lot of that is just the economies globally are slowing, loan growth is slowing, capital markets are not accelerating right now. So, the earnings growth rate for Canadian banks are a bit muted right now. We're still expecting dividend bumps, but a little bit more muted on the dividend bumps, but we're just not seeing the acceleration of earnings in the Canadian banks. The nice thing is valuations have started to contract. So they're starting to look attractive. And I think once we see the capital markets open up, M&A open up, which maybe mid 2024 is when we'll get, closer to equal weight this sector. But again, having 20% of the fund in this sector shows we do have confidence in the stability of our Canadian banks. And you can see how well insulated our banks have been during stressful periods in the market, great financial crisis, COVID. The drawdowns in our banks have been historically a lot less volatile than European, UK, and US banks. So Dean, maybe I'll pass it back to you just to summarize quickly, the main points of the fund.
Thanks, Rob. So really to summarize here, we've got a portfolio in MCT that now has a much more supportive macroeconomic backdrop with rates plateauing and eventually moving lower here. We've got valuations within our fund, whether it be the REITs, whether it be our energy companies, whether it be our financials, that are below historical levels. So in essence, given the discount that we're trading at on the LSE, you're really getting a double discount because you're buying these portfolio companies at a lower valuation. And we've got a dividend here that's well covered in 2023. We're forecasting out to 2024 now, looking to have it well covered as well. So we're in really good shape from that perspective. So really being well positioned to generate very strong total returns for investors as we head into 2024. So thank you for participating in this call. If you've got any further questions, if you've got any questions, please feel free to contact us directly or visit our website where we've got plenty of information on what we're doing in the fund. Thank you very much.